Every empire operates on a mechanism so fundamental that when it stops working, the system doesn't adapt. It fractures. The mechanism doesn't announce its failure, it just stops flowing. And by the time anyone notices, the damage is structural, irreversible. This is what's happening now, not in headlines, in flows, in capital movements that used to be automatic, predictable, circular. For 40 years, the global economy ran on a simple bargain. Oil-producing nations sold energy in dollars. Those dollars flowed back into U.S. Treasury securities. American debt-funded consumption. Consumption bought oil. The loop closed, self-sustaining, frictionless. Economists called it the petrodollar system, but that term misses the deeper structure. This wasn't just about oil pricing. It was about flow direction. Wealth moved from the periphery to the center, always inward, always recycling, always reinforcing American financial dominance. The system didn't require agreement, it required inevitability. And for decades, it had both, until it didn't. Something shifted in the past 18 months, quietly. Gulf central banks reduced their U.S. Treasury holdings by nearly $200 billion. Not a crisis sale, a reallocation. Sovereign wealth funds moved capital into Chinese bonds, European infrastructure, gold, physical assets. The money isn't coming back. And this is not a policy choice. This is a structural breakdown. When a flow that has sustained a system for generations reverses direction, the system doesn't adjust. It destabilizes. History shows this pattern clearly. Rome built an empire on tribute. Wealth flowed from conquered provinces to the imperial core. Egypt sent grain. Gaul sent gold. Hispania sent silver. For centuries, this loop financed legions, infrastructure, grain subsidies. The Annona system, Rome's food distribution, depended entirely on Egyptian wheat shipments. 20 million modi annually, automatic, predictable, essential. The system seemed permanent, invincible, until the flow stopped. Not because provinces rebelled, because they couldn't produce the surplus anymore. Barbarian incursions disrupted agriculture. The Antonine Plague killed millions of farmers. Debasement destroyed currency value. The denarius fell from 90% silver to 5%. Local economies collapsed into subsistence. Trade contracted to regional barter. And suddenly, there was nothing to send to Rome. The tribute stopped. The Annona failed. The legions went unpaid. Soldiers turned to warlords for sustenance. The empire fragmented. Not from external invasion, from internal flow collapse. The mechanism that sustained imperial power simply stopped functioning. The breakdown wasn't military. It was mechanical. The flow reversed, and the structure couldn't function. Britain experienced the same pattern after Suez. For a century, sterling dominated global trade. The pound financed 60% of world commerce. Colonial economies sent wealth to London automatically. Indian cotton revenues, Malaysian tin exports, South African gold production. That capital-funded British industry financed global commerce, sustained the pound's reserve status. The City of London operated as the world's financial center because capital flowed there inevitably, not by choice, by structure. The sterling area, comprising a quarter of global GDP, recycled trade surpluses into British government debt. Automatic buyers, reliable, unquestioning. The system appeared unshakable, permanent. Then Suez exposed the reality. Britain couldn't project power without American approval. Sterling holders saw weakness. They saw dependence. They converted. Rapidly. The Bank of England lost half its gold reserves in 6 months. The flow reversed. Capital fled London for New York. Dollar deposits replaced sterling accounts. Within 2 decades, the sterling area dissolved completely. Not because Britain chose to end it, because the mechanism that sustained it, the automatic recycling of colonial wealth into London financial markets, no longer functioned. The colonies gained independence. The trade flows redirected. The pound became a domestic currency. The empire, a memory. The City of London survived, but it survived as a financial services center, not as the center of a monetary empire. The pattern is always the same. Empires don't collapse from external pressure. They collapse when the internal flow that sustains them stops recycling. And that's what we're watching now. The petrodollar system isn't being attacked. It's being abandoned, not dramatically, incrementally. Saudi Arabia signed a currency swap agreement with China, 300 billion yuan, bilateral, no dollars involved. The UAE listed its first yuan-denominated oil contracts. Russia and India settled energy trades in rupees and rubles. Iran joined BRICS, expanding non-dollar energy commerce. Each event on its own seems manageable, marginal, but together they represent something structural. The automatic flow of petrodollars into U.S. treasuries was never guaranteed by contract. It was sustained by necessity. There was no alternative. SWIFT processed payments in dollars. Oil was priced in dollars. Surplus nations had nowhere else to park capital safely. But necessity is not loyalty, and when alternatives emerge, even partial imperfect ones, necessity erodes. The flow slows, then stops, then reverses. This is where we are now. Look at the data. Gulf sovereign wealth funds held over $1 trillion in U.S. treasuries in 2020. By late 2024, that figure dropped below $800 billion. $200 billion reallocated, not sold in panic, methodically shifted into Chinese government bonds, Asian infrastructure equity, European real estate, physical gold reserves. The pattern is clear. Diversification isn't a neutral term, it's a mechanical description of capital leaving a system. And when capital stops flowing into U.S. debt markets, something fundamental breaks, because American fiscal policy depends on that flow. The federal government runs deficits exceeding $2 trillion annually. Those deficits must be financed. Historically, foreign central banks absorbed 30 to 40% of new treasury issuance. Automatic buyers, recycling trade surpluses into American debt. Predictable, reliable, essential. Japan held over $1 trillion in treasuries. China held similar amounts. Gulf states, several hundred billion. Hoaxer, foreign holders owned over $7 trillion in U.S. government debt. That's not optional financing. That's structural dependency. But if those buyers step back, if they diversify, reduce exposure, seek alternatives, who absorbs the debt? The Federal Reserve can print money to buy treasuries, quantitative easing, but that's not recycling. Purchasing over 11 million barrels daily, the dollar isn't needed for that transaction, not for purchase, not for settlement, not for recycling. The demand decreases, the recycling stops, the flow breaks. Now multiply that across BRICS plus energy trade. Russia, Iran, UAE, and potentially Saudi Arabia, all exploring non-dollar settlement mechanisms. The volume isn't small. These nations represent over 40% of global oil exports. If even half of their transactions shift to alternative currencies, the demand shock is measurable, significant, structural. The global oil market trades approximately 100 million barrels daily. If 20 million barrels shift to yuan, ruble, or rupee settlement, that's 20 million fewer barrels requiring dollar purchases. 20 million barrels daily. Multiply by 365 days, 7.3 billion barrels annually. At current prices, that's over $500 billion in reduced dollar demand per year. That's not marginal, that's foundational. And this is already happening, not hypothetically, observably. China imported over 500 million tons of crude oil in 2023. Increasingly, those purchases settle in yuan through bilateral agreements. The Shanghai Petroleum and Natural Gas Exchange lists yuan-denominated contracts. The volume grows each quarter. This isn't speculation. It's infrastructure. And infrastructure doesn't get built unless the shift is expected to be permanent. The same pattern appears in gold markets. Central banks purchased over 1,000 tons of gold in 2023, the highest level in decades. Over 50 years, in fact. Who's buying? Russia, China, India, Turkey, Poland, Singapore, BRICS plus nations, and those hedging against dollar instability. Who's selling? Mostly no one. The gold isn't being sold. It's being accumulated, moved from Western vaults to Eastern reserves. The People's Bank of China reported official gold reserves of 2,200 tons. But independent analysis suggests actual holdings exceed 4,000 tons. Unreported, stored domestically, held off balance sheet, Russia accumulated gold reserves while under sanctions, nearly 3,000 tons. Unreported, stored domestically, held off balance sheet, Russia accumulated gold reserves while under sanctions, nearly 3,000 tons. Germany repatriated its gold from New York and Paris. Turkey doubled its reserves. Even small nations, Serbia, Hungary, Thailand, are buying. Quietly, methodically. And this is not investment, it's positioning. Gold doesn't yield interest. It doesn't generate returns. It costs money to store and secure, but it holds value when currencies destabilize, when trust erodes, when flows reverse, when the system that promised stability fails to deliver it. Central banks don't accumulate gold because they expect stability. They accumulate gold because they expect the opposite, because their economists and advisors have studied history. They've seen what happens when reserve currency systems break down. And they're acting on that expectation now. Not with announcements, not with public statements, with purchases, with repatriation, with accumulation. And they're acting on that expectation now. Not with announcements, with purchases. The flow of capital tells the story more clearly than any statement. Dollars leave. Gold enters. Treasuries are sold. Alternatives are built. This is not a prediction. It's a description. The question is not whether this will happen. The question is how far it's already progressed. And the answer is further than most realize, because the breakdown is quiet, gradual, undramatic. Until it isn't. Rome didn't collapse in a day. The tribute system eroded over decades. Provinces stopped sending wealth slowly, each year a little less than nothing. Britain didn't lose reserve status overnight. Sterling holders converted gradually, then rapidly. The flow reversed slowly, then all at once. The pattern is consistent. Systems sustained by automatic flows don't fail suddenly. They erode. Each small decision, a reallocation here, a currency swap there, chips away at the foundation. Individually, these moves are rational. Collectively, they're catastrophic. Because once the flow reverses, the center cannot hold. What happens next is not uncertain. History is clear. When empires lose the ability to recycle peripheral wealth into central power, they fragment. Politically, economically, monetarily. The dollar might remain a currency, but it won't remain the currency. The system that depended on automatic recycling, the petrodollar loop that sustained American deficits for 40 years, that system is already breaking. The flow has reversed. What we're watching now is not the beginning of this process. It's the middle, maybe the late middle. The pieces are moving. The infrastructure is being built. The alternatives are functioning. And the flow, the fundamental flow that sustained everything, is going the other direction. Empires don't collapse from attack. They collapse when the mechanism that sustained them stops working, when the automatic flows become optional, when the inevitable becomes questionable. The tributes dry up, the capital flees, the loop opens, and once it opens, it doesn't close again, not through policy, not through diplomacy, not through strength, not through military power or economic pressure. It closes through collapse, through restructuring, through the violent rebalancing that happens when a system built on flow breaks down completely. Through the moment when everyone simultaneously realizes the foundation was never solid, it was just movement, continuous, circular, assumed, and now stopped. This is not a warning. This is a clear description of what's now happening. The flow has reversed. The question is not if the system breaks. The real question is how much time remains before everyone sees it.